Hey everybody, welcome into Mining Stock Daily in this week's long-form episode on a shortened holiday week here in the United States. Thanks for tuning in. We've got two segments for you on this podcast and now YouTube channel. So please, with that said, hit that like, subscribe, leave a comment, feedback, anywhere you get it, whether it be the YouTube channel or also your podcast network. We really appreciate everything. We've got two segments, as I said. First, we welcome in a new guest, Mr. Eric Basmajian, first from EPB Research. I've never been on the podcast before. It's a good conversation. Love to kind of open up the books because it was a volatile day yesterday in markets. Specifically, the bond market was wreaking havoc after a much higher than anticipated ADP jobs report, jobs data came out. So we're going to talk about that and what it means for interest rates and also the equity markets and probably a little precious metals as well. In our second segment, it's a long conversation with McEwen Mining's chairman, Mr. Rob McEwen, and his vice president over at McEwen Copper. We're going to talk about a lot of it about Los Azules and that PEA that was released not too long ago. It's a big project. What does it mean for McEwen Mining going forward? They've got a couple big partners in there from Rio Tinto and also Stellantis, obviously. So, it's a different game than it was when you were just a simple gold mining company not too long ago. So good, heartfelt conversation with Rob and his colleagues and talk about the future of McEwen Mining. Special thank you to Arizona Sonoran Copper, Western Copper and Gold, and also Fireweed Metals for their continued support of the podcast. Good to be back. Next week, we'll be on a much regular scheduled programming here on Mining Stock Daily. So let's jump into my conversation with Eric right now, and then with McEwen Mining. Have yourself a great weekend, everybody. Be well. Hey everybody, welcome into our first segment here on the Friday Long Form episode. We're going to welcome in a new guest, Mr. Eric Basmajian from EPB Research. Fresh meat for Mining Stock Daily listeners. Eric, welcome to the podcast. Thanks so much for doing this.
It's good to be here. Hopefully you're not too hard on me.
I don't think so. I think a lot of people are kind of sticking their head in the gutters. We are recording this Thursday afternoon. And it's a very volatile day here Thursday. Obviously, this is going to happen before the non-farm payrolls numbers come out. So what happens Friday morning, then who's to say? But who's to say that the ADP numbers were going to come in more than double the expectations here? Almost 500,000 on the claims when it was expected 220,000. That's a huge miss, Eric, and it's actually having ramifications. I mean, you had to have been surprised to see those numbers.
Yeah, absolutely. There are a lot of things to consider with this report, and of course, maybe by the time people are listening, we'll have either confirmation or denial from the more widely watched non-farm payrolls number. But maybe if I could just take 1 second and try and outline the way that I process any data that comes in. So I'm uniquely focused, or I shouldn't say uniquely focused. I'm more focused on business cycles and the pure economic data than many other market participants that generally take a markets first approach and then maybe use economic data to supplement technical trading or algorithmic type trading or other different types of swing trading strategies. I take an approach that focuses primarily on the business cycle, less influenced by changes in the market. This business cycle can be slow moving. It can take a long time to evolve. But what's important about the business cycle is that it does follow a predictable sequence over time. Now, the leads and lag time of that sequence can vary from cycle to cycle. But whether you go back to the 1970s and go through the inflationary periods or some of the more modern disinflationary periods, that sequence has always been the same. It's really never been different. And what I mean by that sequence is we can break data up into data that tends to be more cyclical and early moving. We can look at the entire basket of data when a number comes in, like non-farm payrolls, that's the total. Or if we take the difference of the first two categories, we get our non-cyclical or lagging type information. So whenever an economic indicator or a data point comes in, it's first really important to try and process it and say, is this a cyclical data point that's in the earlier part of the sequence? Is this kind of the meat and potatoes, the whole picture? Or is this a very lagging economic data point? Because a lot of times what happens is we get 4 or 5 data points in one day. Some of them are very much on the leading edge of the economy. Sometimes they're very much on the lagging edge of the economy. And we just jumble them all together and comment on them as if they all mean the same thing. So when the jobs number comes in, whether it's the ADP or the non-farm payrolls number tomorrow, that is definitely very much towards the lagging elements of the economic indicators that would signal contraction in the economy. So at its face, it's not entirely surprising to see strong jobs numbers through like leading up to a recession, and even in the beginning of a recession. Historically very common to see strong jobs numbers. So that's the sequence that we should be focused on. As far as these ADP numbers that came in, they were definitely way stronger than expected, and a plus 500,000 number is definitely way outside the bands of slowing economic conditions. But we have to take the ADP numbers with a grain of salt because they've changed their methodology numerous times over the years, and it tends to not be as reliable as some of the other labor market data that we get. So the market tends to not have a huge reaction to the ADP numbers unless it's wildly outside of expectations like it was today. So the shock factor of it definitely caused a reaction in the marketplace, with yields going up and certainly more forcefully pricing in that the Fed may raise rates 1, if not 2 more times this year.
Yeah. Eric, let's talk about some minute things within the ADP data, because I think it's kind of telling. Information, financial services, white collar jobs were the biggest losers. And we know they have been because we see these companies talk about the layoffs that have been happening for the last couple of months. However, trade, hospitality, education, those were the biggest gainers, and a lot of them came from small and medium-sized businesses. And as I guess I don't know if that's a silver lining. In my heart, I'm like really happy to see small businesses doing well and be able to hire. But my question is, when this type of activity happens, what does it mean in the cycle that you've been studying? Is there a linkage there between timing?
No, very much so. So you broke it down well. When I look at the labor market data, whether it's the non-farm payrolls or let's say the ADP number, I break the report into several buckets. So let's use our 3 buckets that we talked about in the first question, which is our cyclical jobs, the total picture, and then our non-cyclical jobs. Our cyclical jobs are going to be the ones that contract or lose jobs ahead of every recession. You're always going to get job losses in the very cyclical parts of the economy. The non-cyclical parts of the economy often don't lose jobs even at all during recessions. The recessions are really born in the cyclical economy. So the cyclical sectors that we're generally most focused on are residential construction, which is a subset of overall construction, and manufacturing. Those 2 categories, if we use the non-farm payrolls data, account for about 20 million payrolls in the United States. And people will say, well, that's not a huge percentage of the total, and that's true. But in standard recessionary periods, you can lose anywhere from 10 to 25% of that cyclical workforce because it's so incredibly volatile with attached to those industries. So on 20 million payrolls, you can lose 2 to 4 million if you do go into a significant recession. So when we look at our cyclical jobs, the residential construction and manufacturing, I don't look at the ADPs too closely, but if I'm correct, I believe the manufacturing sector lost 42,000 jobs in that report. You can correct me if I'm wrong if you have the information in front of you. So we are actually seeing weakness in some of those cyclical categories. And then everything else that you called out, which is your education, your services, your travel, that's all in your non-cyclical basket. So the fact that we're seeing strength there is good from a human element. We want to see jobs. We want to see things do well in the economy, but it's not a great indicator of what's to come. You really want to stay focused on what's happening in residential construction and manufacturing. And I don't think the ADP breaks out residential construction because if you're losing jobs in those categories, that generally means that activity in those categories is very depressed, and there's not a lot of signs that future demand will be high. There's also indications that money and access to credit is probably tight because those two sectors are very influenced by changes in interest rates. So when the non-farm payrolls number comes out, I'll be focused on is there a feed through to manufacturing and residential construction? What's the status there? If we're not losing jobs in those categories, then the economy is much more resilient in the labor market. If we do see a continued reduction in workforce in those categories, that would be a sign that we're still on the path of more recessionary conditions to come.
I think it's pretty obvious that manufacturing in the United States is in a recession. It's been pretty dire here for another couple of months, and I really appreciate you kind of breaking this down. But I want to talk about a little bit more of the reaction, and really the reaction in the bond market here today, Eric. Yields went really high. In fact, I like to follow the 2-year yield. That's been a pretty good barometer, specifically watching the commodities and metals prices, what potentially could happen. So let's talk about that. It's back over 5%. In fact, that's the highest level it's been since winter, early winter this year. But the 30-year, later down the line, that's actually hitting some pretty stiff resistance around 4% here. The curve continues to be inverted. However, are we starting? Is there any takeaways other than the yield skyrocketing after this, and we'll see what happens after NFP? I mean, is there any initial signs of where the bond market wants to go just based on this day of trading? Other than higher.
Yeah, that's right. So what's happening is that the Fed, the Fed's guidance changes quarter to quarter. So it's not like what they say has a lot of staying power, but their latest guidance was that they penciled in a terminal Fed funds rate of about 5.6, which is somewhere in the vicinity of 1.5 more hikes. So the market tentatively started to price that in, but still was pricing in a lot of cuts because there's a lot of recessionary indicators that continue to flash big warning signs. And then there's also a wall of maturities and lots of issues in commercial real estate that many market participants don't believe the Fed will let reset at the current interest rates, meaning that the Fed would have to lower interest rates before some of those maturities occur. Otherwise, you'd have a lot more distress in credit markets. So the bond market was 1 foot in, 1 foot out on the Fed's guidance. But after today's data, which was much stronger than expected, the market has moved to start pricing in more seriously the Fed's guidance. So that's where the 2-year yield is shooting up, and you're starting to get the bond market accept that the Fed is going to hike this month with about 100% probability at this point. We'll see if the NFP changes that. And then they're pricing in about a 50% probability of another hike in September, which is your 1.5 hikes that the Fed sort of outlined. So if the NFP number confirms anything even remotely close to what the ADP number came out with, the market's either going to stick with this pricing or even may start to push it and go from 1.5 more hikes to 2 more hikes.
Now, how about the relationship between the bond market and the equity market? It's been a wild run in the equity market, thinking that investors were trying to call the Fed's bluff. They were pricing in a rate cut. And obviously they hadn't gotten that the last couple of months. They kept on really pushing it higher, but this kind of solidifies, at least in my mind, solidifies the deal that rates are going to go higher, but this bond market cannot support another raise in the equity market. I mean, something's got to give here, Eric.
Yes,
I believe the equity market's going to fall. How about you?
Yeah, so today's reaction was a step in that direction, where we had the equity market rallying quite strongly on the idea that the Fed was going to pivot. And if you look at your charts, I have a chart that I posted on my Twitter that shows the performance of various stock indexes over the last several months. And if you draw a line on March 9th, that was really the pivot point for the equity market, where equities, specifically the technology stocks, from March 9th through basically until today, went up 32% in a straight line. Almost didn't go down for a day. It's hard for me to believe that we saved the economy or positive economic developments occurred on March 9th and the things that were exposed on that day. But what happened was that the Fed certainly came in and provided a lot of support at a time when we didn't have job losses yet. So there was a strong signaling effect, in my view, to the market that the Fed the Fed is still, despite their tough talk, standing there willing to backstop any credit events that occur. So their words are tough. They talk strongly at the meetings and they penciled in a lot of rate hikes. But then when the rubber meets the road, the market does believe that they're always going to ride into the rescue. And that was certainly further ingrained after the March 9th Silicon Valley event. So from that moment, the technology stocks and the stocks that generally do perform well when the Fed is cutting rates or easing policy really took off. But the bond market only priced in that pivot for a brief period in time. Here we are where they fully priced out that move, but yet the equities have not reversed the same. Mm-hmm. So if the Fed is going to execute on these next 1.5 or 2 hikes, which the bond market is now starting to price in, I also agree with you that you're going to have to see a repricing in the equity market that got way ahead of itself on what was a Fed pivot expectation.
I want to play a lot of these financial market conversations on this channel or any other channel is kind of this like what if game. And I tweeted something earlier this morning, Eric, that like something's going to break. We saw the price of higher rates during the regional banking crisis. That's still on the table in my mind. There, with these moves, there could be more to tumble. We'll see. We'll see what happens. But what would cause the Federal Reserve to come in with that Fed put once again? I don't think it's the equity market. I think they want a lower equity market. I don't think it's that. Maybe it is just a credit crisis. Maybe that's a simple term. I don't know if it's the housing market because they want houses to be more affordable so people can come in and buy. It's the lifeblood of the U.S. economy, right? I guess there's a number of things that could break that just haven't, even in the last year where rates have gone really high really quickly. We've had problems, there's been cracks, but nothing's truly broken for the Fed to come out and really take action. In fact, they're saying longer for high, or higher for longer, excuse me. So I guess let's play this. What could it be? If it's not the equity market, if it's not the housing market, I mean, is it simple as fact that we need something major like a credit crunch for them to step back in?
Well, I think that is probably what you need, but I think it's worth reviewing the SVB scenario because that definitely was something breaking. And what was um, uncomfortable about that event, with the benefit of hindsight, is that all of the things that you mentioned that the Fed desires, a lower equity market, a looser labor market, and lower home prices, all of those things would have been almost the immediate result of the Silicon Valley failure had they not orchestrated what, in hindsight, was clearly a bailout of some really bad behavior. Um, so it does beg the question of what they really want and how they want it to unfold, because they would have achieved lower inflation, a looser labor market, and lower home prices after that event. And that event was ultimately going to result in a massive contraction in credit, which is the mechanism of how interest rates slow down economic growth. So it's like they got exactly what they wanted, but it just came too forcefully and too abruptly. And it still showed that they have a lot of fear about contagion or letting things unravel. And in this particular case, I'm not even referring to the Bank Term Funding Program, really as much as the decision to backstop uninsured depositors,
Right.
all of which were highly sophisticated depositors, all of which knew what they were doing, but still decided to take extreme amounts of risk in terms of having multiple billions of dollars in uninsured deposits in exchange for sweetheart type deals. That behavior was backstopped, and that was a pretty uncomfortable event, considering it hurt what the Fed is trying to accomplish. So if we have another event, it's likely to be or an event that causes the Fed to react. It would have to be something similar, a contraction in bank credit, or just a more broad seizing up of financial conditions. Things like that will probably prompt the Fed into action again. But we have to be careful about the direction that we're wandering, which is that when the Fed raises rates, there are certain consequences that come. And it does seem at the moment like central banks around the world are raising rates. The consequences of those rate hikes are manifesting, but then they're backstopping some of those consequences. And as a result, the Fed has to hike even more. If they did not do what they did during the Silicon Valley debacle, we probably wouldn't be talking about rate hikes. We'd be talking about probably a lot of rate cuts. So they found themselves in a little bit of a difficult position, a lot of it of their own making, which is that they're saying things and they're outlining goals that they desire, but then when those consequences of their actions crop up, they have what is an increasingly robust reputation of stepping in to avoid some of those more dire consequences.
It's a version of lack of accountability in many ways. Yeah. Eric, I know you've got some great videos out on your YouTube channel, your Twitter accounts, super solid, tons of, the way you approach the markets, you're able to communicate those on both of those platforms. So I encourage anybody who's got, any ideas, big picture thing, please, Eric's a great follow. I do want to ask you about precious metals, though. I don't know if this is something you follow closely or how closely you follow precious metals, but what is what is the role here in this business cycle? What are you seeing?
Mm-hmm. So I'll give my broad stroke commentaries on precious metals. It's intertwined with the business cycle. It's not anything that's all that surprising, but generally, when I look at the commodity or the metals complex, I look at their level of cyclicality, or basically how tied is that metal to industrial activity. The more the metal is, or the more the commodity is tied to industrial activity, the more it's going to trend with the business cycle. So copper, for example, would be a commodity that has a very strong track record of following the ebbs and flows of the business cycle, because the swings in demand tend to be quite large depending on whether the manufacturing sector around the world is expanding or contracting. We heard so many stories, and probably accurately so, that copper was in short supply and there was going to be upward price pressure because of that. But we're seeing that the global economic cycle and the downward momentum that's occurring in China and Europe and the United States are outweighing those supply concerns, and the price of copper is going down. So when the economy around the world, specifically the manufacturing sector, is declining and has a negative forward outlook, generally the industrial commodities will perform poorly. The offset to that would be how gold performs. And gold, to me, is less correlated to the business cycle, used more as a diversifier and an uncorrelated asset. The way that I like to use gold is to use it as a base for a lot of different expressions. So copper tracks the business cycle. Copper to gold tracks the business cycle even better. People may think that silver has properties that are similar to gold in terms of the way it tracks the business cycle. But if you look at the ratio of silver to gold, it tracks the business cycle quite closely, meaning that when the economy is headed towards recession, you want to prefer gold over silver. When the economy is experiencing an acceleration, you definitely want to prefer silver over gold because it has that industrial kicker to it. So broad strokes, that's how I think about the commodity and metals complex. When growth is decelerating and there's a negative manufacturing outlook around the world, that's going to put a depressing effect on all industrial commodities, copper being the biggest one. And when the cycle is accelerating, there's a boom time in all of those commodities. We definitely experienced that in 2020 and 2021, and now we're starting to see the reverse side of that with a lot of the more industrial-based commodities.
Eric, I'd love to follow up with you again and see how this all plays out in the coming months. But how can people follow you? Tell us a little bit more about EPB Research and what you do.
Yeah, so you could find me on YouTube and on Twitter at EPB Research on both platforms. I provide business cycle research, so I provide weekly and monthly publications to clients that alert them to developments in the business cycle, always separating what's happening with the leading economy, the lagging economy, what the different components of those things are, and then also giving ideas to businesses and business owners about how they may be able to improve their strategic planning by following this business cycle and also understanding where their business falls within the more leading or lagging elements of the economy. So epbresearch.com is where you can reach out to me if you have any questions. And other than that, I look forward to recapping again soon.
Yeah, thanks, Eric. I appreciate you doing this. Have yourself a great week.
All right, you too.
All right, you are back here on Mining Stock Daily. This is our Friday long form episode on somewhat of a shortened holiday week. Second segment on the long form, and it's an important one because we are going to get an update from long lost friend here on the podcast, Mr. Rob McEwen, and his vice president over at McEwen Mining, Mr. Michael Medding. Gentlemen, welcome back to Mining Stock Daily. Good to see you.
Great to see you, Trevor. Thank you.
Yeah. Thank you so much, Trevor. And I'm the VP and for McEwen Copper, the copper part of the business.
Oh, did I say McEwen Mining? I apologize. I meant I didn't say what I meant. I meant McEwen Copper. But a lot of this is I want to focus the conversation to start off really on McEwen Copper here with both of you, because there was an important preliminary economic assessment that was published for the Los Azules project down in the San Juan province of Argentina. It's a big project. Rob, I mean, I don't know where the size and scope of this project, where it sits with your career. It's got to be right up there with size, and obviously, I would assume cost as well. I'm wondering if we can kind of jump into this conversation really about the size and scope of this, and then maybe kind of get into the nitty-gritty details of the economics of Los Azules. So, Rob, where does this stand? Where does Los Azules stand as far as size and scope for you?
It's big. It's very big. Since I have a gold background, I'll just convert it into a gold equivalent for the readers. It's 37 billion pounds of copper in the indicated and inferred categories. And if you were to take the gold price divided by the current copper price, you come up with a ratio a little over 500 pounds of copper is equal to an ounce of gold, and divide that into the 37 billion pounds, and you're looking at a 72 million ounce gold equivalent deposit that you could mine for about under $750 an ounce. So there are not many gold deposits that size, and so copper is it's a very large resource. It's very long life. The PEA was only looking at 27 years of mining because there's different types of copper ore, but it's only representing 1/3 of the total size of the deposit as currently defined. And we are quite encouraged by our drilling that suggests the deposit could be significantly larger than what we have right now. So multi-generational, low cost. It's considered the 9th largest undeveloped copper deposit in the world. So just on your comment on size, it's big.
Yeah.
And it'll
sorry, go ahead. I didn't mean to interrupt.
I was just thinking it'll have a very profound impact, positive impact on the value of McEwen Mining as it goes along. It's also fully funded for the next year or so.
An independent mineral resource estimate, an updated resource estimate, came along with this PEA. That stands at 10.9 billion pounds of copper indicated, 26.7 billion pounds of inferred. So that's how we're getting those numbers. Mike, let's talk to you about the economics of this project. 27-year mine life. What was the base case copper price used for this, and what do these numbers now look like, even though it's still preliminary in nature?
Yeah. So we used 375, and we think that this is in line with current consensus. We also think that there is significant upside potential going forward. We think that with the base case that we developed a balance between a mine that has sufficient good economics, while on the other hand, it is something that is financeable and buildable. If you look at those mega projects, if you look at how much it would have cost to build a comparable size conventional concentrator, you would have probably needed at least twice that amount of money to be able to build it. I mean, we had PA stage, but we have used updated information as available at this point in time. And we think from an economics point of view, it's a very good entry with upsizing potential. We also made the conscious decision to forego some part of the potential contribution from the gold and silver that you would get paid for potentially if you use a concentrator, in favor of better environmental performance, lower energy consumption, lower water consumption, generally much lower greenhouse gas emissions, So this is really something where we think we made a very good compromise between strong economics and a good environmental footprint.
Okay. And so you're really focusing on the leachable copper here. Why focus specifically on this and not, the big standard circuit, which obviously would increase the cost? Why keep it simple here?
Looking at it, Trevor, it's about social license. In Argentina, where this mine's located, they'd gone through a drought for several years. It's a source of water for the capital of the province. And so water is a critical issue, and conventional brine flotation systems use enormous amounts of water, in addition to a lot of capital and a lot of power. And we thought, well, going heap leach, you don't have nearly as much water consumption. It's about 75% less water than the conventional. Your power requirements are lower, and but we are sourcing all our power from renewable sources. And your carbon emissions are much lower, about a third. We're starting at a third, and we're going to a point where we hope to be carbon neutral by 2038. We're planning to be. And your capital is considerably lower. So as Michael was saying, we were looking for something that would be reasonable to finance.
Yeah. Well, so there's a couple of things I want to kind of build upon there, but with this water consumption, and you also mentioned the carbon footprint, and these were two things that kind of stood out to me in the news release when this was published, is because I don't think very many people, if anybody, publishes the estimated site-wide water consumption and the CO2 the carbon intensity in the PEA bullet point items. And so obviously it goes to show you that these aspects of your projects are increasingly important. I don't necessarily think they've hit standard delivery for PEAs or any technical reports for that matter in these really important bullet point items. So I'm just kind of wondering your approach, because obviously ESG, these items are going to be important moving forward, but very few companies are actually putting them on the forefront of the highlights of these technical reports. Do you think that's something that maybe will happen more frequently, if not being standardized going forward here, Rob?
Without question. There's going to be, it's the political agenda, the general population's consumption. I mean, what we're trying to do is, let's call it environmentally responsible, but also to try to convey to the public that, well, mining, first of all, has to go on if we want to green the climate of the earth and control climate change, because it needs metal for solar cells, it needs it for windmills, it needs it for EVs, and we don't have enough production right now based on the demand curves that are being projected. But you're looking at it, and we also need to convince or try to help the general public see that mining can be different, and hopefully they would embrace it more, because one, for just permitting and community acceptance, but the other, and it's quite critical, is we're having a shrinking workforce. At one end, you have 10 to 15% approaching retirement very quickly. And at the front end, you have a dramatic drop in students going through mining schools, schools of geology. So at both ends of the age spectrum, you're losing your workforce. And yet the demands for additional metal is increasing dramatically with the transition of energy and the attempts to control climate change. So we need to encourage the youth. We need their energy. We need their talents, their attitudes to transform this industry, to help us transform it. So it's try to get more people coming through the door and have more people saying, yes, mining is there and we do need it, and they're doing a better job than they did before. So hopefully we can help provide one of the models for the industry going forward.
Mike, tell me about the workforce in San Juan province right now. There's a lot of mining activity, a lot of exploration going on. How hard is it to find workers and labor with projects right now?
I think that what Argentina has seen, generally speaking, not only San Juan, is very little exploration over, I would say, the last probably decade. Mm-hmm. And all of a sudden, Argentina became more relevant, more attractive, relatively speaking, to countries such as Peru and Chile. So when we started our last drilling campaign, we saw the difficulties in getting machinery and getting good drillers, good helpers, and generally staff into roles that require certain qualifications. And it was also difficult to get sufficient geologists with copper porphyry experience. Now we have solved those issues, as one can see by the drilling meters that we did in the last campaign, whereas the one before, and we think we have a good set of qualifications assembled in the team, both within our own organization as well as with the contractors. But there is certainly competition, and even though mining pays the highest salaries also in Argentina together with oil and gas, sometimes it's difficult to get the right people. This is the reason why we launched several training programs ourselves, as well as together with our contractors, to make sure that we have sufficient workforce available when we go into the next drilling campaign starting end of September, beginning of October.
Okay, very good. More back to the project, and then we'll kind of move on to a couple of other things I wanted to chat with you about. The all-in sustaining costs, I think I saw, was about $165 a pound of copper. So margins, given the current copper price, look pretty dang good. You used a base case of $375 in the PEAs, so margins I think were about 56%. Looks really solid. Well, again, short snippet of what Los Azules might look like. That's what a PEA is. It's preliminary in nature. So this kind of gives everybody a glimpse. But I do honestly want to talk to you about the CapEx. It's coming in about $2.5 billion. And we know the size. We talked about it. And there's probably a question for both of you, to whoever wants to jump in here. How does, if Los Azules, it will continue to move down the road, there will become a time where construction financing, a decision needs to be made. $2.5 billion maybe isn't as surprising as it used to be, but it's still very expensive. How does a company like McEwen Mining set forth in getting this project financed, all things variable?
First of all, before we go into the general structure of financing that maybe Rob wants to answer, if you look at the capex that we estimate, it's actually quite low compared to a conventional concentrator. I mean, a little bit of a smaller project than ours with a concentrator in the same province has an estimated capex of more than 4.2 billion. Yeah. And this comes also because of more complexity, comes with higher inherent risks. Now, those guys, our colleagues, they are feasibility stage, so they have more detailed information than us. Obviously, we are in PA, but still, I mean, the selection of our flow sheet, the production, was based on what is financeable and what is doable for a company I would say also of our size, considering that we have two important partners. We have Rio with a 14.2% stake, and we have Stellantis, the fourth biggest automaker in the world, with 14.2%. Both of them have the contractual right to continue financing all through construction if they wanted to. So I think that's something that is very positive for us.
So it is a large amount of money, 0.5 billion. As Michael said, it's much less than what had been proposed in the earlier PEA. That would be a $4 or $5 billion investment. So where do you get the money? Having one of the more attractive development stories out there for copper makes capital a little closer. I do believe that the ESG movement, there's PricewaterhouseCoopers estimated there's there's over $30 trillion that are in funds around the world looking for ESG projects. Copper is indispensable in modern civilization, and if we stop mining copper today, we're going quickly into the dark ages because we won't be able to move civilization forward. So I think there's a source of funds there that wasn't available before. And I think if mining companies move in the direction of protecting the environment, they could experience some very low-cost financing there because of those giant pools, enormous pools of capital focused on there. We're going to be socializing Los Azules with the world as we go forward over the next year or so, as we're completing our feasibility study. And I'll be able to answer that question as to what will be the cost of that capital as we get closer to that date.
Well, the cost of we're recording this the Thursday morning. The cost of capital's changed overnight, as we've seen. Rob, listen. Here's a little bit of a holistic question for you, based on kind of following up on you. The way mining companies are doing business now is different than the first time I sat down and chatted with you 5 or 6 years ago, and it's different on the base metals copper side than it is the gold side. And so maybe we can open this up a little bit. On the gold side, any gold exploration or gold mining company that was looking for a partner would typically be looking towards big gold producers to come in as JVs or strategic investors. And that was about the extent of it. But on the base metal side, we're seeing not only big base metal producer and mining companies come in as partners, such as Rio Tinto and the Newton technology with the likes of McEwen Mining for Los Azules, but we're seeing OEMs, the Stellantises, come in. That is a whole nother, I don't want to say complexity, but a whole nother level of opportunity here that copper, base metals, energy metals have that maybe the gold industry doesn't have. How have you kind of learned to recognize these changes in those specific niche mining sectors and know what can work with one doesn't necessarily work with the other?
Well, just looking at the news over the last year or so with the war in the Ukraine, the sanctions on Russia, the sanctions on Iran earlier on, the tensions, the geopolitical tensions going on elsewhere in the world, it's had a very big negative impact on global trading patterns. And what you're seeing right now is these large manufacturers, particularly in the auto industry, are looking and saying, we might not be able to get all the raw materials that we need to build our cars. We should because trade routes and relationships have been disrupted so severely. And I'm looking at what the auto industry is doing is what Henry Ford did when he was building his Model T. He went and got Firestone to go down to Brazil to the rainforest to have a rubber plantation for tires, create tires. He went up to Michigan to get copper. He went to Sudbury for nickel. And you're going, these guys are vertically integrating because they have to if they want to make good on their promises of producing the EVs in the numbers that they said. And I think that's all sorts of manufacturers also across many industries are looking and saying, well, what's happening to the cost of our product? Or are there some critical elements that we need to manufacture, whether it's a dishwasher, a fridge, a car, a computer? And they're cutting these private deals. When Stellantis came in, they were the first auto manufacturer to invest in a copper deposit.
Yeah.
But we've seen them going into lithium. We've seen them going into nickel, or the battery people. But I think it's going to extend far beyond that because we became very comfortable with global trading patterns and being able to source all over the world. And then you combine that, we've just come out of a period of 6 years of interest rates that were low to negative around the world. And that's another complicating factor that's come in. And you're looking at development cycles for mines that they haven't become shorter, they've extended because of a lot more regulatory oversight and requirements. So people are just trying to, I think you'll see a lot more of that. And you can look at a list, Michael printed off, go on, you go, Stellantis put 5 million euros for a 19% stake in a Norwegian nickel play. And then Volkswagen, Stellantis, their batteries, they're going around looking for nickel. And then Ford's supporting nickel in Indonesia. And then Tesla's considering a takeover of a lithium company. General Motors is bidding for one of Vale's base metal businesses. Of course, it'll probably get sold to the Saudis. And so everybody's just sort of looking around pretty quickly and saying, how much metal do I need and who am I going to have to compete to get that? So if I can look at something that's out there, you're going to see more of that vertical integration. I'm quite convinced of that because of geopolitical disruptions.
What does this integration look like between both manufacturer and miner? I mean, I've heard that Tesla is interested in actually producing its own lithium, but the idea is, I mean, shouldn't car manufacturers stick with car manufacturing because that's what they're really good at and allow the miners to be the miners of the products? I mean, what does that relationship between two very different entities look like going forward now that the waters are starting to get muddied a little bit more and more?
It's like the conglomerates of the 60s, where there was all this vertical integration. And I'll come back to the global trading patterns and world trade, free movement of goods around the world. That clearly isn't happening today. And just the tensions. I mean, you can look at, I'll go to a Home Depot, and there were all sorts of power tools that were so cheap, it seemed, for quite a while, but they're being manufactured in Asia or elsewhere in the world in low-cost districts. But right now, the tensions are developing between that part of the world and our part of the world. And I suspect a lot of things are going to go up in price as we try to repatriate that production back to our countries, back to America, Canada, Europe, because disagreements in how the world's operating right now.
Yeah.
And on top of that, you see that investment, for example, the Stellantis investment that we have. I mean, yes, we are very happy that we got the $155 million at official FX rate from Stellantis, but it's more than that, because Stellantis has a clear vision on wanting to become carbon neutral by 2038. They asked for the same commitment from us. So Rob is very strong on pushing the way we do mining towards something greener, more sustainable, towards a paradigm shift. So from a strategic fit point of view, that works very well. And Stellantis has production in Argentina. They have about 4,000 direct, including indirects. They have about 25,000 employees, manufacturing about 180,000 cars, out of which half of it is exported from Argentina. So they have a very important footprint in Buenos Aires and in Cordoba, two rural centers that traditionally are not that amenable to mining, that are now all becoming ambassadors, because those 25,000 people have a direct or indirect stake in our copper project in San Juan. So it brings mining towards the urban centers. A person that takes his Peugeot 208 in the future to northern Argentina, or to drive on the weekend to go for camping or whatever, they will use copper that was produced partially in our mine. So this changes the whole narrative around mining for people in the urban centers, where a lot of the decisions are made.
I'd add to that, Trevor, that the push is more than just the political push. It's some of the largest customers of the mining companies, or the users of the product they produce, are saying, and we've seen it in Stellantis' case, they're pushing their policies onto the mining companies and all their suppliers of material, and saying, look, we've made a commitment to go carbon neutral by 2038, and if you want to sell us any product, you have to be carbon neutral, because they're looking all down the chain, the C1 through 3 carbon footprints. And that will be a big factor that I don't think a lot of the industry is thinking about right now.
Right. I want to take a step back, and I got two or three other last questions. But what we haven't talked about in this conversation thus far is the relationship with Rio Tinto and the Nuton technology. We have seen colleagues of yours also working with Nuton, having preliminary results out from those studies and technology, again, preliminary in nature. And we've talked about that, a couple of them on the podcast thus far. We had a good conversation with Joe Mazumdar last week regarding Nuton, and kind of from an analysis point of view, and a very smart one, I might add, what he would like to see before it actually is included in economics. Would love to get a general update on that relationship with Los Azules and Nuton. What seeing will there be a time where McEwen Copper publishes those preliminary results with Rio Tinto?
Yeah, so there are certain results from our colleagues available. There was initial testing results from Arizona Sonoran Copper. Recently, Regulus Resources came out, I think it was today or yesterday, with good-looking results on their phase 1 met testing. We are in phase 1 met testing with the colleagues from Rio through Newton, and this could be adding a lot of additional value to the project. It's important I think for your listeners and your viewers to understand that our base case is standalone, so it doesn't include any kind of process or production improvements that we may see coming forward from the collaboration. The collaboration with colleagues from Newton is quite close, so we have frequent updates on the testing program. Generally speaking, the collaboration with Rio, we just went to see the exploration work that Kennecott is doing on our other McEwen Copper project, which is Elder Creek. So there's frequent interchange in what's going on. The results look certainly interesting from what we have seen, and they could, if all works out, present a significant upside potential on an already strong business case that we have at the moment.
We'll publish it once we get the final results at the early stage.
Very good. My last question really is the future of Los Azules and McEwen Copper. The number of projects, I think the legacy, Rob, of McEwen Mining really maybe is the foundation with gold. However, I remember you talking about Los Azules years ago, actually, on this show, of wanting to make sure people were paying attention to Los Azules here going forward. So that maybe Los Azules and McEwen Copper is the future. I guess, how are you balancing all this out? Is there any ideas of separating McEwen Copper out of McEwen Mining into a different equity? What is the thought process, or is there no thought? It's like you're going to keep Los Azules within all of McEwen Mining and that's it?
No, well, when we talked earlier, Trevor, our precious metal operations were struggling, and our treasury was low. And I thought the market, it often has a preference for a pure play, so pure precious metal, pure base metal, or copper. And so started a strategy to pull it out so we could finance the copper separately. And so I put 40 million in August of 21, and I thought we wanted to raise 80, and it'd be a piece of cake to get the other 40. Well, it took about a year, and it was August of 22, and we were able to get the other 40. We got another 42 million. 25 of that came from Rio, and we raised 82 million. And then Stellantis came along, and Rio stepped up and increased their stake. So between August of 22 and the beginning of March of this year, we raised a total of $267 million private. Of that, about 48 million was through a secondary, where McEwen reduced its interest from 68% to 52%. And we funded Los Azules. We had talked about doing an IPO during this period of the year, this year. But when we did the financing in late February, early March, we weren't in need of capital immediately. We expected to be it if we hadn't done that financing. So the IPO was pushed off, and it was probably fortunate in that the base metal prices dropped as well. I mean, copper came from 480 down to 370, 375, where it currently is. And so the market wasn't receptive. Our treasury was full and would carry us into next year. And so we're still looking at that. Between McEwen Copper, or McEwen Mining owns 52%. I have just under 14% myself. So we're at 65% ownership. But I can see, I always felt that we could elevate the profile of Los Azules through McEwen Copper, and that would enhance the value of McEwen Mining. And so I think McEwen Mining, we have McEwen Copper, we have a portfolio of 5 royalties, we have the precious metal assets, and I think there's an $8 to $35 a share value behind every share of McEwen Mining. And it's starting to surface as Los Azules gains greater profile, and people appreciate its size, but also the performance of the McEwen precious metal assets are improving and delivering on guidance. So I still see a day when McEwen Copper would be a publicly traded vehicle. And I would suspect at that point our ownership would be below the 52%. We have royalties on the 2 copper projects in McEwen Copper, just because I envisioned a day when that ownership would go down, and I don't know, maybe a large company looks at it, but I'd like to see if we could build this new model for mining. I'm really very excited about pushing that forward.
Yeah. Is this stage of the game, especially with this large project with Los Azules, Rob, is it more challenging now than it was previously just playing in the gold space? Are you faced with new challenges in this part of your career?
Well, definitely. I mean, the capital we're going to raise is greater. And there are geopolitical issues that come in. There are, governments, communities. This is a larger project than doing an underground mine or even a small open pit gold mine in Nevada.
Right.
But I think it's something the world needs. And if we can do it in a way that excites the market. I mean, when I was running Goldcorp, we were looking to put a new, there was a negative feeling about mining. And I asked our engineers to paint the top 30% of our head frame in gold. And why would you want to do that? Well, it's going to add a sparkle to the landscape, and that's our business. And there are a lot of people who come up here, fly in to where the mine was, and they'll see it and they'll notice it. And then we were building in Nevada, and I thought, well, do you paint a mine and the process plant and all that? Do you camouflage it so no one can see it? And that's the wrong approach. We should be proud of it, and we should turn it into a jewel on the landscape. So it sparkles and is a point of interest, a positive interest. And so by extension, looking at Los Azules, when we first started doing our planning about 1.5 years ago, I brought in an architect who is very prominent in the green living building space. In fact, he's considered by many to be the Steve Jobs of the green living building industry. Said, help us redefine mining. Help us change the way it's perceived in the marketplace, how it, no more than just perception, how it operates, and how it is complementary rather than destructive. So that's where the big excitement comes from. So the challenges are small. They pale in comparison to the excitement of moving forward here.
Very good.
And the good thing is in Argentina, where we have the project, there's experience in operating this size of open pit mines. One of the reasons we looked at this size and heap leaching was also because there's experience in San Juan. There are suppliers that can actually build, constructors that can build a leach pad of the size. So from that point of view, from an execution risk point of view, I think this helps a lot as well.
Very good. All right, gentlemen, I appreciate your time. Thanks for spending a little bit of your day with us, and thanks for the update. Mike Medding, Vice President over at McEwen Copper, Rob McEwen, Executive Chairman of McEwen Mining. It's good to connect with you both. I look forward to probably seeing both of you this fall in Beaver Creek. Look forward to it.
Absolutely. Look forward to that, Trevor. Thank you for the interest.
Yeah. All right, everybody, that's a wrap here this week on Mining Stock Daily. We'll be back Monday morning with the morning break with some regular scheduled programming. Have a great weekend. Be well.